Great. Thank you, Courtney. Good afternoon, everyone. I am Linda Knowlton, your FAMP president, and so happy that you all are here. We have such a wonderful and I'm sure exciting webinar. We all love in the mortgage industry just evaluating tax returns. I know it's one of my favorite things to do. So today we have MGIC evaluating self-employed borrowers for the tax year of 2020. So I am going to just give you a couple housekeeping items, and then I'm going to turn it over to MGIC. This will be recorded. This is being recorded today. So all of you that are in attendance, you will receive a recorded copy. It will also be on the FAMP website for members. So we thank you all for being members. And for those of you that are not, we would like you to consider joining, because you're here for a reason, for information that we as FAMP can supply through our wonderful industry partners like MGIC. It is my honor to introduce Dennis Rodriguez. She has been around FAMP as long, maybe a couple years longer than I have. She currently is our bylaws chair. She has been the chapter president for the Broward County for 3 years plus, or you were on the executive, you've been on the executive committee forever. And just an all around rock star to me and to our family at FAMP. So Dennis, I am going to have you introduce our incredible speaker.
Thank you so much, Linda, and thank you everyone for being here. It is a great pleasure to not only be part of FAMP and be a state director and be involved with a great group of people, but we're like a family, as Linda said. So I am the account manager for the Southeast corridor from Fort Pierce all the way to the Florida Keys. And I will be the one that helps all our lenders and brokers in that area. We do have 2 other account executives in Florida. That is Turner and Ivy. They cover the West Coast as well as Central Florida. And with Christy Buff, our sales manager. But with that being said, Jeff Platfoot, he's going to be taking over and doing the webinar for all of us. There's a lot of information that Jeff will cover, and I'm sure there's going to be a lot of questions. Jeff is our director of training for MGIC. He is one of the best. So Jeff, please take over.
Well, that's one way to raise the bar really high. I like the bar a little lower than that, but I appreciate it. And I'll tell you folks, as we were getting ready to let you folks into this Zoom meeting, Dennis and them were complaining about how cold the weather was down in Florida. And I'll just let you know that I live up in the Columbus, Ohio area, and the 17 inches of snow we got over the weekend is melting because we're now into the 20s and 30s. So yeah, I'll just leave it at that. So there's a reason why we come down to Florida all the time from the Midwest, is that weather. So, but again, thank you for having me today. We've got a short amount of time set aside today for a lot of information. We encourage you to ask questions in the chat box. At the end, I'll get to those questions, or at least to as many as I can, depending on time. Everything that we're going to chat about today is going to be what's most common, customary, typical approach to looking at tax returns from the secondary market standpoint, Fannie, Freddie. I'm going to get rid of my camera because that just distracts me. So I'm going to get rid of that and move this around here. And I always say, the approach from the secondary market, because you folks could have a twist or an internal overlay that I'm not aware of, maybe an investor that you work with. So keep that in mind as we're chatting today. There are, excuse me, I love this screenshot because I've been in this business for about 34 years, and all of my experience has either been in sales or in underwriting. And when you see all this paper, I think it feels true sometimes. We ask for borrowers' tax returns, they come in the door, and it's this just heaping mountain of paper. And, then really it's, where do we start? What do we even do? And I know many of you on this call today are probably on what I call the front lines. You're from origination, taking the application, processing, putting it together, getting ready to send that loan into underwriting. So from that standpoint, you know, there's a lot of income calculators out on the market. Fannie has theirs, Freddie has theirs, all good, all work the same. Today, I am going to reference our MGIC worksheet. It's our SAM worksheet. It stands for Schedule Analysis Method. And what that simply means is we go and look at the schedule to determine what we need to work up, what we need to work up, and where we need to go. So today, I'm going to walk through, excuse me, a Schedule C sole proprietorship, and then we're also going to walk through Schedule K1s for partnerships and S corps. We'll show you examples of income and losses, and go from there. So with that, what I recommend, and let me also preface this by saying, you're going to see today the materials that we gave you. I put a PDF attachment with the Outlook invite. The PDF attachment matches this PowerPoint. I also gave you a couple of our worksheet calculators also if you wanted to use in the future. These materials are through 2020 tax returns. Our 2021 material sets will be rolling out here in the next few weeks. So the good news is there's no significant changes. So we'll be able to work through this, assuming this just as easily up here at the top could say 2021. So what I recommend is when your tax returns come in the door, when the borrower, you asked for them, the borrower gave them to you, is to make sure that you always focus on line 8 right here. And when I look at line 8, if you see any dollar amount sitting here, whether it's a positive amount or a negative amount, it could be large, it could be small, it doesn't matter. You're not going to use the dollar amount for anything. If there's a dollar amount sitting on line 8, that tells you that you need to make sure there is a Schedule 1 included in this tax return. And Schedule 1 to me is the key. Because when you go and look at Schedule 1, there's 3 lines that I encourage you to look at, and they pertain to being self-employed. Is there any dollar amount sitting on this line where it mentions a Schedule C? Any dollar amount sitting on the line mentioning Schedule E or Schedule F? These 3 lines, self-employed related. If you can work up a Schedule C sole proprietor, you can work up an F, which is farming. So today, we're going to start right here with the Schedule C. And walk through the ins and outs of this. So let me get this moving here. This is what our MGIC worksheet looks like. And again, there are a lot of different calculators out on the market. If you do them correctly, use them properly, you're going to get the correct answer. They all work the same way. Ours has a bunch of extra bells and whistles built into it. One thing that's nice right out of the gate is that in green right here, we tell you what line number to go to find what you're looking for. So it says line 31, that's line 31 of the Schedule C. Go to line 6 of the Schedule C. So we tell you even where to go. Most of this is going to be go to that particular line, grab the number, let's plug it in. And the worksheet's going to do the work for you. There is one line right here, the second one, it says deduct non-recurring income right here, line 6. This is other income, folks. And excuse me, what I recommend to sales and processing especially is that if you see income sitting on line 6 of Schedule C, income, positive income sitting on line 6, subtract it out on your worksheet. So the income that you see on line 6 of Schedule C, bring it over your worksheet and subtract it out. Now, what I'll say is that I tell you that because often when this file goes into underwriting, underwriting is going to subtract that income out. So the income sitting on the Schedule C, you're subtracting it and removing it on the worksheet. And the reason why underwriting so often will subtract that out is because it is non-recurring. It's not there both years. It's not consistent. It's other income that doesn't have anything to do with this business. So often underwriting will subtract the income out. Now, if you do that out on the front line processing sales, I think what happens is that you have a more accurate income, you have more accurate ratios as your file flows into underwriting. So let's sort of put this together and see what it asks us to do. We're going to grab depletion and depreciation. Meals and entertainment are being subtracted. We've got business use of home and some mileage sitting here. If you use my worksheet, you can grab the mileage and the worksheet will calculate it all for you based on what the IRS parameters are. So if I go and look at Schedule C, I see today my borrower is John. He owns this company called Tech-In-A-Sec right here. Again, folks, this is 2020. It just as easily could say 2021 right here. All of the income for this business comes in the door. I pay all of my expenses, my bills, and I get my bottom line right here. So my worksheet says go to line 31. Grab the bottom line profit or loss. Today, it happens to be a profit, positive, $37,200. That's our starting point. I don't know why this little thing will not go away. So 37.2 is our starting point. Then our worksheet says deduct out non-recurring income, and that's where I said go to look line 6. If you see income sitting up here at the top on line 6, I recommend that you subtract it out on your worksheet. So we're going to subtract that $3,500 out. We're then going to go, the worksheet says, let's go grab depletion and depreciation on lines 12 and 13. Today, we're going to add back $2,400. And then it says, let's go subtract out meals and entertainment on line 24B. So we're going to subtract $1,000. And then the last thing we're going to do for the first page here of Schedule C is add back business use of home if it exists. And today, there's nothing there. And if you look at my worksheet says go to page 2 of Schedule C. This is page 1. Let's go to page 2 of Schedule C. And we're going to be asked to look at line 44A for mileage. Today there's 12,000 miles, so I'm going to plug that onto my worksheet. My worksheet will then determine what the IRS calculation is and figure that out for you, the mileage depreciation. And then the last thing that we're being asked to do on this bottom of page 2 is to see whether or not there's any amortization or casualty loss here. You're going to see all kinds of expenses listed in here. But on your worksheet, it says amortization casualty loss. That's what we're looking for. We're not going to add back expenses like dues or laundry. We are going to add back expenses that are, say, amortization, which is really rare, folks, or we're going to add back casualty loss, which is some kind of a claim, an insurance claim on my business's structure. So today there is a casualty loss of $300. So we're going to add that back to our worksheet. So for today, for 2020, if I look at my worksheet, I grabbed my bottom line, 37.2. I'd subtracted out my other income. I grabbed my depreciation and subtracted my meals. I grabbed my mileage, 12,000 miles. The worksheet added $3,240 for mileage. And I added back my casualty loss. So for today, I came out with 38,640. Now, for time purposes for today, I'm not going to work up both years. But folks, if you can work up 2020, you can work up 2019. You're doing exactly the same thing. Or 2021 when it rolls out here in a couple weeks. So if I were doing a 12-month average, I would have $32.20 a month. If I were doing a 24-month average, I'd have $31.15 a month. So Whether I have one Schedule C business, sole proprietorship, or if I've got four. If I've got four on my worksheet at MGIC, you can come over here and click on this little plus button, and it will allow you to open up and add additional businesses, which is a great feature as well. So what we've been doing up until this week, from here, we've been having discussions with regards to financial statements and also with regards to profit and loss statements, those types of things. And those guidelines have changed as of, I believe it was Friday, February 2nd. And the agencies announced that they are relaxing, my word, relaxing the requirements for profit and loss statements. In many cases going forward, we will not be required to get profit and loss statements, and we won't be required to get bank statements either. So that's per the agency's announcements just a couple days ago. What I want to ask everybody on this call, and we've got a very large group on this call, and a lot of different lenders represented. Please double check with your underwriting or your investors' underwriting and determine if they've adopted these new guidelines through the agencies, which I would think they would, and if they have any extra spend to them or, that kind of thing. But the good news is the requirements for those profit and loss financial statements and bank statements, again, have been relaxed. And in many cases, you won't be required to get them. So that is great, great news. A side note, tax day this year is April 18th. Monday, April 18th is tax day. So up until April 18th, if you're asking for a borrower's most recent 2 years tax returns, you're getting 2019, 2020. If they've completed their 21 returns, then of course we'll get those. But after April 18th, tax day, if your borrowers have not filed their tax returns, they will have to file an extension through the IRS. And you would want to get a copy of that extension. And what that does is then it reverts you back to reviewing the most recent 2 years, which is 2019 and 2020. So we're sort of in this limbo period. We are every year this time of year. Right now, everybody's getting their tax returns prepped, ready, and done. Self-employed folks always takes longer. So, over the next few weeks leading into March, we're going to start seeing these 2021 tax returns coming in the door for self-employment, which is going to be good because it's going to allow us to get less documentation for those financial statements. So we worked up our Schedule C business tech in a sec. We just worked that up. And we also, last year at MGIC, we did build a separate calculator included in this worksheet. And it's designed to walk you through a profit and loss cash flow. So this is built into the worksheet that I gave you today. And if you've got to obtain a P&L statement, you can plug in the year and the dates that are provided by the borrower, and you can grab the information from that P&L statement. And you'll notice that we built this last year to mirror the same language as how we look at the tax returns right here. We use that same language for when we're looking at a P&L. So again, hopefully you won't have to use this as much as we have had to in the past. All right. Folks, when I mention Schedule E rentals, or I'm sorry, when I mention rental properties, the first thing that pops into my mind is Schedule E, page 1 of Schedule E. You folks work with a lot of borrowers who have rental properties. Doesn't have anything to do with being self-employed. They own rental properties. And what you will do is go and take that information from the Schedule E and plug it into your origination system. Most of you have your origination system. You go into your REO section, which is the real estate section, and you will plug this information in from the Schedule E onto there. We do have an excellent Schedule E rental calculator tool. If you don't have that, please feel free to reach out to Dennis as we can get that emailed to you. But it's a great tool. For today, staying on focus to talk about being self-employed, we're going to talk about page 2 of Schedule E. So again, page 1 of Schedule E is rentals. Do your thing in your origination system, your REO section. Page 2 of Schedule E focuses me back on the self-employed piece. So when I look at page 2 of Schedule E, this is what's going to pop up for you. You'll notice here it says income or losses from partnerships and S corps. So folks, when I look at this sheet of paper, there's a lot of information going on here. I look at this as a quick glance of the eye. I don't look at any of these dollar amounts, passive, non-passive. I don't look at any of this. If there's a business's name listed here, the reality is you may or may not have known about these businesses. If you think about it, we just worked up John. He owned that Schedule C business called Technisec. Walked through that. And now John also owns 2 partnerships, Tanglewood Realty and Westchester Development. And John also has ownership in Digital Network Systems, 2 partnerships and an S corp. And again, you may have known about these, but many, many, many times we had no idea these businesses even existed until we get the tax returns in our hand. So when I've got page 2 of Schedule E sitting in front of me, like we do right now, and I see a business's name, the rule is I need to get a Schedule K1 for each business listed here, a Schedule K1. And I'll bet folks, when you ask for tax returns, many, many times when you ask for tax returns, your borrower provides the return, but those Schedule K1s are never included in there. And Schedule K1s are a part of my personal tax returns. But I think the reason why the K1s are never in there is because the IRS does not require them. And that's a big piece there. But in our world, from a mortgage lending standpoint, we do have to require and review those Schedule K1s. So if I see here the need for K1s, which I know I do, there's businesses' names listed here. If I don't have the K1s, we're going to have to email, get on the phone, whatever we need to do to get those K1s. And the reason why they're so important is it tells me 2 very specific pieces. It tells me how much my borrower owns of this company. It also tells me whether or not my borrower made money or lost money from this company. So I'm going to walk through 2 scenarios today. We've got 3 businesses here, but I'm going to walk through 2 of them. Here's Tanglewood Realty. This is going to show us here in a second a loss. We'll talk about that. Then we'll give you some examples and we'll talk about Digital Network Systems, which is a positive. But I'm going to start with Tanglewood Realty here first. This is a partnership, and I get my hands on the Schedule K1, and this is what it looks like. So here's the Schedule K1 for Tanglewood Realty. And the first thing I do is look at letter J down here. How much does my borrower own of this business? And when we're talking about a 1065 partnership, you'll see there's 6 percentages listed here. And it's pretty simple for today. Our borrower owns 20%. But the reality is down here in letter J, you could have percentages all over the board, literally numbers all over. You could have 100%, 80%, 2%, I mean, all over. So I've got one that's highlighted here with my arrow. So end of the year, capital right here. This is the one I call my trigger. And I say it like that because That's the one I'm really focusing on, that number, end of the year capital. And if this percentage is 25% or more, as a rule, I know I'm going to need to ask for the business tax returns as well. Right now, I've just got the borrower's personal returns, which include these Schedule K1s. But if I own 25% or more of a business, I then will get the business tax returns. Today, I can see I own 20% of this business, 24.99% or less. The rule is going to be that I don't need to ask for or work up the business tax returns. So this is the partnership piece of my MGIC worksheet. We're always going to work up the K1. Your borrower may or may not receive a W-2 from this company they own. If they do, let's plug that in here. And here's how I work up the business tax return, which I'm not going to need to do because I don't own enough of the company. We're always going to look at the K1. There's not a lot we have to do. When I talk about a Schedule K1, I'm going to look at the first 3 lines of the K1. Do I have any ordinary income or loss sitting on line 1, or any net rental income or losses on lines 2 or 3? And when we reference a partnership, you may run into what's called guaranteed payments. So let's talk about that a little bit. So I'm back to this K1. Again, I know my borrower owns 20% of this business. My focus is going to be on these first 3 lines of the K1. Today, there's a loss, a negative $5,800 sitting here. And we're going to have to account for that loss and subtract it on our worksheet. We're then also going to see right here, there is a guaranteed payment of $2,000. And, you know, I tell people, you know, everything we do in our business with regards to mortgage lending is a lot of it's based on recurring and non-recurring. I have a recurring income. It's consistent. It's been here 2 years. I'm going to use that. We say that with bonus, overtime, commissions, recurring 2-year history, consistent. We say the same thing when we talk about self-employment. We say the same thing when we talk about guaranteed payments right here or any of these pieces. Do I have a 2-year history or not? If I don't have a consistent 2-year history, then it's probably determined that it's non-recurring and I don't use that as income. So for today's purposes, if I were to look at 2019 tax returns, you would see that I do have a guaranteed payment each year, which is good news for us because I'm going to use that guaranteed payment as income, which at least it helps to offset my loss of that $5,800 right here. So what we take from this is excuse me, although the bottom line of this business showed a loss of $5,800 for 2020, we do have a consistent recurring guaranteed payment that I use to at least offset that to $3,800 for last year. Again, you can see if we were working up 2 years, 2019 had a bigger loss. And overall, we have a 24-month average of $575 negative for the month that we would decrease our overall income with this loss. Folks, this is an example of a loss, and it's on a partnership K1. This just as easily could say S Corp. Just as easily could say S Corp. So how we tackle one's how we tackle the other business. So let's talk a little bit about when you have a Schedule K1 and there's income on the K1. And we don't just go to the Schedule K1 and grab the income and throw it onto the worksheet. We first have to determine whether or not our borrower accessed the income. And we do that by looking at what's called acceptable distributions. And I'm going to explain that to you here in a second. And if we can't determine that there are acceptable distributions to support the income I want to use, we then will go and create what's called a liquidity test. And I'm going to show you that here in a second as well. But let's first talk about using income and determining whether or not the borrowers access the income. So I've got a couple scenarios I want to share with you. So you have a K1 sitting in front of you. It doesn't matter if it's a partnership K1 or an S Corp K1. I've got a K1. There's income sitting on the K1, and I want or I need to use the income to qualify. If you have a Schedule K1 sitting in front of you, and there's a history of receiving acceptable cash distributions, and those acceptable distributions are consistent with the income you want to use, you're golden. Use the income, throw it on your worksheet, move on, you're done. Here's what I mean. This is an S Corporation K1, 1120S up here. And right here, again, we look at the first three lines, there's $14,800 sitting here as income. I'm going to say my scenario is I need that to qualify. Without it, my ratios aren't looking good. Well, don't just go and throw that on your worksheet and use it. You first have to see if you have acceptable distributions to support this 14A. So for me to determine that, I have to go down to box 16. And when you look at box 16, this is distributions. This is distributions. It says items affecting shareholder basis, it's distributions. And you see there's a dollar amount sitting there. And when I look at this dollar amount, you'll see a letter, this letter right here. So I want to stop there. I am not the IRS. I am not a CPA accountant. I've just been doing this a long, long time. And what I do know is that the IRS has many different types of distributions. They have different types of distributions. And each distribution has a definition, and each distribution has a letter attached to it. So what we are looking for when we are inside of an S Corp K1, 1120 S Corp, is we want to see distributions. Acceptable distributions have a letter D as in dog. The letter D means income. Different letters mean different things. So the letter D is very important to us. In this scenario today, right here in front of us, I've got income of 14A. I have acceptable distributions, letter D, which means income, of 14A. I am in good shape. I'm going to use this 14A income up at the top to qualify. I'm going to plug that into my worksheet. I am done. I'm going to change the scenario one more time here. I don't know why. And flip this screen from an S Corp to a partnership. And you're going to see it looks like it's almost the same piece of paper. And if I change this to a partnership, it's a 1065 partnership. So again, here was the S Corp. S Corp, I'm looking for the letter D, meaning income. I flip to a 1065 partnership. I'm going to tackle this the same way. In this scenario, I've got 19.8 sitting here as income. Do I have acceptable distributions to support this 19.8? I come down here to box 19. It actually says distributions. But when we're inside of a partnership, the letter A, as in apple, means income. So in this scenario, I have acceptable distributions that support the income that I want to use to qualify. So partnerships, letter A, S Corps, letter D. I'm going to change my scenario up just a little bit more for you one more time before we go back. I apologize. I don't know if you've seen this little screen at the top, but it's sort of driving me bonkers here. Let me see. Let me switch my scenario up here. And let's change this to, I think, something a little more realistic. I've got a scheduled K1 sitting in front of me. There's income on the K1, and you want to use the income to qualify. But the K1 does not reflect a history of receiving acceptable cash distributions. Or maybe you've got a K1 that shows acceptable distributions, but those distributions aren't consistent with the income that you want to use to qualify. So we've got two options here. Let me show you what they are. So here, folks, is an S corporation K1. And again, I apologize. This little thing on my screen is driving me bonkers, which I know doesn't affect you, but all right, there we go. We've got this S Corp right here. I've got $85,000 sitting here, and I need to use this $85,000 to qualify. First question, do I have acceptable distributions to support this income? I need to go down here. Since this is an S Corp, I go down to box 16, items affecting shareholders' basis. This is distributions. There's nothing there. That is a reality. It happens often. There's nothing here. I don't have distributions, but it doesn't change the fact that I still need to use this 85 grand to qualify. Well, that is when we will create what's called a liquidity test. That's when we're going to create a liquidity test, which I'm going to show you here in a minute. Before I show you that, I want to change this scenario one more time. Let's say I've got this 85 grand sitting here. I'm going to change it. I'm going to say, excuse me, I do have acceptable distributions, letter D, and there's 8 grand sitting there. Awesome. This is good. My problem is this 8 grand does not support the $85,000 I want to qualify, to use to qualify. Excuse me. One thing you folks can do very, very simply, very easily, is you can reduce this income, 85 grand, reduce it to not exceed the distribution. So reduce your 85 grand to 8. That's what your distributions are at the bottom. If this lower amount brings your ratios to where you need to be at, qualify, acceptable, run with it, you're done. Use this lower amount. But if you try that and you're thinking, oh, that 8 grand is not enough, I need the 85, well, then we'll go create a liquidity test. Excuse me. So again, this is an S Corp. We tackle S Corps and partnerships exactly the same way, with the difference being income and the type of distribution letter, A and D. So what I'm going to do, folks, is we talked about Tanglewood, which was an example of a loss. Now what I'm going to do is talk about Digital Network Systems, which is an S Corp. We'll walk through this, and then we'll take our remaining time and go through your questions and Q&A, that type of thing. So here's Digital Network Systems here. So here's the S Corporation piece for my worksheet. I've got this 32,550 sitting here for Digital Network Systems. I need to use this 32,550. So we know the question is, do I have acceptable distributions to support this? So I come down to box 16. And today you see there are distributions sitting here. There's $500, but there's a letter C. That doesn't work. We're inside of an S Corp. I need to see the letter D. So in this scenario, I have 0 distributions in our eyes from a qualification standpoint. Folks, if I take this $500 right here, add a couple zeros. Let's make this 50 grand. Let's make this 50 grand. And a lot of folks will say, my gosh, 50 grand, that's more than I needed. This is awesome. I can use this 32,550. If this is 50 grand and a letter C, you have zero. That's how important the letter is. S corporation, letter D, as in dog, means income. Remember how I said different letters mean different things? I don't even know what a C means or stands for, but I know it doesn't work for us. If this were a partnership, I look for the letter A. So I don't have distributions. I want to use this 32,550. So what I need to do, folks, is I just determined I have not been able to show that the borrower accessed the income. So since I can't show that, I'm going to have to create what's called a liquidity test. And the good news is they're pretty simplistic to create or to put together. I did include as a tool our liquidity worksheeter. I heard it. Of course, we're recording that worksheeter. I included our MGIC worksheet for liquidity. And what we're going to do, folks, is we need to look at the balance sheet for this business to be able to create a liquidity test. So the easiest way to create this liquidity test by looking at a balance sheet is to look at the balance sheet inside of the business's tax return. So here is my MGIC liquidity worksheet. And you'll see what we're going to do is advise you to go to Schedule L of the business return. We're going to grab a few assets right here. We're going to look at that same Schedule L. And the Schedule L, by the way, is a balance sheet. We're going to grab a few liabilities. And what I want is my assets to be at least equal to or greater than my liabilities. So let me show you where we get this from. Schedule L, balance sheet, assets. Here is the business tax return. And up at the top, it says balance sheet. And you'll see that it says assets right here and liabilities. We are not going through all of these assets. We're not going through all of these liabilities. But we are going to go through per the worksheet, look at a few of these assets right here at the top, liquid. We're going to look in column D, end of the year. We're then going to look at a few of these liabilities, which are short term, and add those up over here at the end of the year. So add up my assets, I come up with 127,480. If I add up my liabilities, I've got 44,1. Just a quick review right here. I know I'm sitting good. I know my assets, and again, the rule is my assets are equal to or greater than my liabilities. So if this was 44,100 over 44,100, I have acceptable liquidity. I'm beyond that. I'm what, 2.5, 3 times that. So in this scenario, I know I very simply can go back to my worksheet. I can grab this $32,550 that was sitting on that K1, and I can use that as qualifying income. I didn't have distributions. I didn't have acceptable distributions, but I do have acceptable liquidity. All right, folks. Excuse me. Again, we today provided this PDF so you could follow along. Hopefully you took a few notes, that type of thing. We also included this MGIC worksheet, which is going to be rolling out with the 2020 update here in the next week or so. We also provided you that liquidity worksheet, which walks you through and tells you exactly where to go when you're looking at creating a liquidity test, the Schedule L here. And I also mentioned, and I don't think I included for today, is we do have a really nice rental calculator worksheet too that you can always grab And you can get that by going to mgic.com, and you can grab our worksheets there. And you'll see we've got all income analysis worksheets, rental worksheets, liquidity here, those type. All of it's sitting right here at our website if you'd like to access those. So I wanted to see, I see in the chat box, we have, let's see, recording. Linda, you mentioned minus equals plus 6.
Well, that really wasn't me. That was a little creature that crawled across my my keyboard. So I apologize. I can ask what question he'd like, but no, I apologize.
I'm good. Well, because I was going to say, I don't know what that means. So, but I get it now. If, you know, if you had a little pet walk across the keyboard, I get it now. Good.
Yes. Dump the instructor. There we go.
There you go. There you go.
But I did.
I'm
okay,
sorry,
go ahead.
Go ahead.
Oh, some of the, when you showed the different letters for income, you said there's different letters there for that mean different things. Is there a cheat sheet on that? Was that included? Because I did remember the one for income, obviously, but is there one we should kind of really watch for if it's not income or something that could possibly throw us off there?
Well, there is a document within the IRS that explains what each of those letters mean.
Okay. All right.
But none of them are acceptable except the one I told you about.
Okay.
So when you're inside of this S Corp, I just brought this back up. Here's an S Corp. Acceptable distributions income, letter D. I don't know how many different types of distributions there are, but the letter D is the only one that's going to work for us.
Okay.
I know there's distributions out there. There's one out there referencing jewelry. There's one out there referencing artwork, and they have different letters. And like I said, S Corp letter D is income. For a partnership, letter A is income. So I don't know if it's really necessary to have a list of what all the definitions are for all of these types of different types of distributions, simply because none of them work except for the A or the D.
Okay. All right.
No, it's a great question. So that's why I said in this scenario here, there's a C. I don't even know what C stands for. You know, I just know this this defined distribution C, which was for $500, does not work because I know the only one that does is the letter D, which means income.
Okay.
Yeah.
All right. Perfect.
Good.
There is a question here on the balance sheet. How do you know which lines to include?
And that's a great question. Excuse me again. It's a good time. If I'm going to lose my voice, it's at the end of the session, I guess. We gave you, excuse me, I should add that the balance sheet has a lot of stuff sitting in there, obviously. When you look at this, there are, 27 lines here between assets and liabilities. And if you can, until you get comfortable with it, I would recommend referencing our liquidity worksheet I gave you. And this worksheet, whether you plug the numbers in or not, it will tell you assets right here. I'm going to go to line 1 and look at column D. I'm going to go to line 2B and look at column D. So when I go to my balance sheet right here, line 1, column D, $16,100. So it's nice, this can guide you, this liquidity worksheet I gave you can guide you exactly where you need to go when you're looking at the balance sheet. So it's a great question.
Okay, great. And yes, everyone that is attending today or have attended will get a copy of this recording. Yes.
Okay.
So any other questions that anyone has out there? I think there's definitely some great information, Jeff, today that kind of just zeroed in on the things that we really need to know, because they can be very overwhelming at times, for sure.
Yes, they can, can't they?
Mm-hmm.
Yes, they can. I saw something pop up there.
Yes, where can we get the forms? We can attach, if you send the forms to us or your website,
Yes.
which you prefer?
We can do both.
Okay.
Dennis or myself can make sure you have. I had put them in the Outlook invitation to begin with. I don't know if they, you know how that works. They could have gotten filtered out somewhere. But Dennis or myself will send over the rental, the self-employed, the liquidity. And then also at any time, if you want, you can go to mgic.com and you'll see right here, it says training. We do ask for your name and email, that type of thing. And the reason we do that is because every year when we update our worksheets with any changes or the new year, anybody that's signed up automatically gets an email saying, hey, the new ones are ready. And
Right.
I think we send out about 190,000 emails, I believe it was. Just a huge amount, an email over the next week or two when the new ones roll out. It's nice because you don't have to ask, are they updated yet? You'll get an email saying, hey, here are the new ones, and they'll be attached and you can just overwrite them and, you know, on top of the old one, which is nice. So
That is great.
MGIC.com, but in the meantime, we will definitely also include the attachment. Yes.
Okay, super. Well, if there aren't any other questions, we'd like to wrap it up then. Dennis, would you like to say any final words?
Yes, thank you, Linda. Thank you, Jeff, for always for a wonderful presentation. And yes, you can definitely access the forms at mgic.com. I put it in the chat box, the link to access the forms, and we will go ahead, Linda, and send it to you and Courtney as well, so you can share with all the registrants. So thank you all for being here. Continue quoting MGIC, and we look forward to seeing you all soon.
Yes, thank you. Thank you, Dennis, and thank you, Jeff, for a great presentation. That didn't put us to sleep, I'll tell you. So, it's always a plus.
Yeah.
So we really, really appreciate it. You were absolutely wonderful. And everyone, thank you for joining us. Thank you for supporting FAMP and supporting your industry. Everyone have a great rest of the afternoon.
Thank you. Thank you, Linda.
You're welcome. Thank you. Bye-bye.